Welcome back, everyone. I hope you're having a great day as always. And in this episode, we're going to take a look at the 4 companies to keep on your watch list throughout this upcoming trading week. And as we do every single Sunday, we're going to break down all the upcoming and major events over the next few days and take a look at the companies who will be directly impacted. And over this next week, we have a mixture between a couple key earnings reports and a few big presentations that I believe will have a direct impact on the company's underlying share price. So in this video, we're going to take a look at the 4 different stocks. We have companies from different sectors in the market. We have different sizes in terms of market caps, and we also have companies who generate revenue in very diverse ways. So in this video, we're going to take a look at the company's current operations, the reason why they're included in this Sunday's episode, and the future expected growth. But before we can take a look at that first stock, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first company we're going to go over in this episode is ticker ADBE, which is Adobe. They trade for $541 per share, and this is a software giant that is up by 39% on the 1-year chart. The company is trading with a current market cap at $259 billion, and they do sit with a very high forward PE ratio, right around 45.8. And Adobe is one of the leading software companies in the world. They have so many different products, their platform is top notch, and the company currently operates under 3 main business categories, which include their Adobe Creative Cloud, their Adobe Document Cloud, and of course, the Adobe Experience Cloud. And combined, all 3 business segments create one massive ecosystem of products and services offered under the Adobe umbrella. And we can see that year after year, the company continues to expand their product line, offering new services to consumers. And another reason why I like Adobe very much, and I'm actually bullish on this company long term, is not only because they're a software-based name, but because they generate revenue through a subscription model. Year after year, month after month, you can sign up for a subscription, and that allows for consistent and growing cash flow to come into Adobe, and it's very predictable over the long term. So as the company continues to lead the market with high quality products at, I believe, a very reasonable price point, and they continue to bring out new services year after year, I think Adobe is a software company that's going to be very, very successful for long into the future. And taking a look at their investor presentation, they find so many different ways they can grow over the long term as well. All these different ideas are different ways the company can expand their applications, their services, and their platforms. So I think going forward, Adobe is definitely a brand in the software-based sector that comes with very high margins and is very profitable to take a look at for your own portfolio. And I included them in this week's episode because the company shares their latest earnings on June 17th. We have a revenue estimate of $3.73 billion and EPS to come in at $2.82. And over the past 90 days, analysts are only getting more bullish on Adobe's report. We've seen 20 upward revisions in EPS expectations and no downgrades. And over the past 4 quarters, Adobe has beaten analyst guidance every single time, and for this next quarter, they're forecasting 15% year-over-year expansion in the company's total earnings. And we can see that over the past 5 years, the company is still growing at a very fast rate. Back in 2016, they did $5.8 billion of total revenue. Fast forward to the trailing 12 months, that has now grown to over $13.6 billion, meaning they've more than doubled their total revenue during the past 5 years. And year over year, we're seeing that exponential growth, which is projected to occur for long into the future. And taking a look at the bottom line, on $13.6 billion of revenue, the company's net income was at $5.56 billion, meaning they have a net margin of 40%. A 40% net profit margin is absolutely spectacular, and that's kind of a theme within the software sector. So all these companies who provide services through cloud networks or software, because they don't have a high infrastructure rate, the costs are pretty much minimal. And the fact that these companies are so profitable is what I believe makes them a very attractive investment. So a 40% net profit margin coming on Adobe at this current point in time. And going forward, if we take a look at the analyst expectations, they're projected to grow between 17 and 18% per year for the next 5 years going forward. And right now, the stock is considered a strong buy at a 1.7, and the current share price of $541 is still below the 12-month expectation of around $570. So Adobe is definitely a software-based name to take a look at for your own portfolio. They're reporting their earnings this week, and although the company is trading near all-time highs, if the investors in the market don't like what Adobe reports and we see a pullback in the share price, it may create a great opportunity to buy the dip in a leader in the software sector that is very, very profitable. So that was stock number 1 for today's video, and now if we continue on into stock number 2, we have a very different company that operates in a completely different manner than Adobe, and it is ticker LEN, which is Lennar. They trade for $92 per share and have seen some major expansion over the past year of around 62%. But we can see that from a high point just below $110 per share, the company has been trading downwards over the past few months. And currently, this is one of the leading home builder companies within the United States. And as consumers and individuals are leaving jam-packed cities and small apartments to go move into outside suburbs and bigger homes, home builders have seen a growth in demand throughout the pandemic. And the trend of moving away from big cities due to remote work is expected to continue for long into the future. And if we take a look, this company has a current market cap right around $28 billion. They're trading with a very, very low forward PE ratio of only 8.3, so a lot of value coming to this company at this current point in time. And the company does pay out a very slight dividend with a current yield of around 1%. And I included them in this Sunday's episode because Lennar does report their latest earnings on July 16th after market close. We have a revenue estimate of $6.21 billion and EPS of $2.37. And taking a look, over the past year, they've seen some major beats on guidance expectations, beating by 43 cents, 54, 46, and then 30 cents in the prior quarter. And take a look at the expected growth rate for the next 3 quarters in the future. 43% year over year, 40% year over year, and then another 15% expansion year over year as well. So they're forecasting some major growth in Lennar in their earnings over the next few quarters. And taking a look at the numbers, over the past 5 years, for what I believe to be somewhat of a boring company, just a traditional home builder, their revenue has more than doubled over the past 5 years as well, from just under $11 billion back in 2016 to over $23.3 billion in the trailing 12 months. And if we take a look at the company's net income, they generated over $3 billion of profits during the past 12 months, and as the company's total revenue continued to expand year after year, so has the company's profits. Only $911 million of income back in 2016, that is more than tripled to over $3 billion during the past 12 months, which is a very strong sign. So overall, Lennar's income statement is trending in the right direction. And jumping over to the balance sheet, I think this company is in a very healthy financial position at this current point in time. We can see they have over $2.4 billion of cash and total current assets of around $22.6 billion. And of course, of their total assets, because they're a home builder, a majority of that comes from their current inventory and the supplies to actually build the homes. So of course, usually high inventory would be concerning, but understanding the nature of this business, and we can see that over the past 4 or 5 years, they've always maintained high inventory levels, I'm not too worried. And taking a look at their short-term liabilities of only $1.7 billion, the company, with over $2.4 billion of cash, has so much assets on hand, they'll be able to deal with these liabilities without any worry. And overall, if we take a look at their long-term debt, it's actually been declining since 2018 of around $8.5 billion down to $7.7 and currently sits around $5.6 billion. So the company's done a nice job of reducing their liabilities over time as well. And total liabilities for the entire company set at only $11.5 billion when total assets come in at over $30 billion. And on the balance sheet, total equity has been growing year after year after year. So I think Lennar's financial position is very strong at this current point in time as well. And going forward, analysts do like the company. They're forecasting over 10% expansion for the home builder. And at this current point in time, they are considered a light buy, and the $92 share price is actually pretty far below the 12-month expectation of around $110 per share, implying another 20+% upside to get to the 52-week target. So Lennar, the home builder company that has seen a growth in demand as consumers are shifting away from compact cities into more widespread suburbs, have seen some growing demand that I think is long stead and will continue long after the pandemic is over. So definitely a company to take a look at. They're sharing their latest earnings later on this week. And now we're going to continue on into stock number 3, and it is ticker MSFT, which is Microsoft. They currently trade for $257 per share and are up by 38% on the 1-year chart. The company has a market cap at $1.94 trillion and is the second largest company in the S&P 500. And I recently made a video outlining all the positives around Microsoft because this is now the largest company in my personal portfolio, and I have over $16,000 invested into this ticker. And I included Microsoft in this Sunday's episode because the company's presenting at the 2021 E3 conference. This is the most highly anticipated and important video game conference of the summer, and Microsoft is a key speaker. And at this event, we're going to look forward to new news and updates on the Xbox line of products, Halo, Starfield, and new games expected to come out in late 2021. So if you're unaware, Microsoft owns Xbox. So they already have a big foot in the gaming sector, and going forward, Microsoft has made it a priority for the company to expand in the gaming industry. And in a recent interview with the company's CEO, he went all in on gaming, explained the company's focus to push into that sector and to become the leader in the overall video game atmosphere over the next 5 to 10 years. He sees the industry continue to grow annually for long into the future. He explains how it's a very profitable market and how Microsoft has the foundation through the Xbox to maintain leadership and grow in that industry. And recently, the company has announced a new product directly related to their Xbox cloud gaming service. And they're developing a hardware product that can be plugged directly into your TV to allow you to have access to all the cloud-based games. And if you're unaware, Microsoft has a new service called Xbox Cloud Gaming, which is what I believe to be the future of the entire video game sector. So essentially, Microsoft has developed a product that acts like a Netflix, but for video games. So when you log into Netflix, you see all the different movies and TV shows, you scroll through and you click what you want to watch. They've developed a product doing the exact same thing, but with video games. It's all cloud-based, you do not have to download any of the games you want to play, and you scroll through the plethora of titles, select what you want to play, and you can instantly play it and stream it online through the cloud network. So essentially what they've done is make a new hardware product that they're going to come out with very soon that allows you to plug it into your TV, similar to like a USB stick type product, and that will give you direct access to all the different cloud-based games offered under Xbox Cloud Gaming. So I'm a big fan of this service, and I think it's really going to help Microsoft grow and expand in the industry over the next few years. And if we take a look, although we already know Microsoft has some of the strongest financials in the world, we'll take a quick peek at their income statement to show you how strong the company really is. $91 billion of total sales back in 2016, and they currently sitting just below $160 billion in the past year, which is absolutely remarkable. And just taking a look at their profits over the past 4 quarters, they've generated over $56 billion of income, which is absolutely insane in a 1-year span. And taking a look at the company's future expected growth of around 17% per year for the next 5 years going forward, and the stock is currently considered a strong buy, coming in at a 1.6. And the current share price of $257 does sit below the 12-month expectation of $293, which is a very strong sign. And taking a look, this company overall has been one of the strongest performers in the market over the past 5 years, and I think they will continue to outperform the overall average for many years to come, which is why I've made them the number 1 position in my current portfolio. We can see right now I own 64 shares with a total market value of $16,500. I'm really looking forward to this event, and overall over the next week, if Microsoft can impress their shareholders with their new announcements in the video game sector, we may see an uptick in the share price going forward over the next few days. So Microsoft was stock number 3, and now we're going to transition into the 4th and final name included in this week's episode, and it's going to be ticker ORCL, which is Oracle. They trade for around $83 per share. These seen some great expansion from the 2020 lows, growing by 61% over the past year, and this is a company that pretty much gets overlooked in the tech sector. They haven't seen tremendous growth over the past 5 years, but the company is still a beast with some strong operations. They have a market cap at $239 billion. They're trading with a forward PE of only 18.5, which is pretty reasonable for a tech leader, and they have a nice yield at 1.5%. And I threw them in this week's episode because they do report earnings as well. We have a revenue estimate at $11.04 billion with EPS of $1.33. And over the past 90 days, 2 upward revisions and 2 downgrades, so a pretty balanced expectation coming over this report. And over the past 4 quarters, they've beaten guidance every single time as well, and we're still forecasting around 11% expansion year over year. And if we take a look at the company's income statement, over the past around 4 or 5 years, they have stayed pretty steady between $37 and $40 billion of total revenue. Slow, tiny upward momentum over the past year, but nothing too dramatic. So the company isn't really expanding at a fast rate. Definitely not the top tech company to consider for your portfolio, but if you're looking for a brand over the shorter term with a big news event coming out, definitely one to take a look at. And if we take a look at their bottom line, their net income over the past year was around $12.8 billion, meaning they have net profit margins right around 30+%, which is still very strong for the tech sector. And currently, they do offer a dividend with a yield at 1.5%. Their payout ratio is extremely low at only 28% of their net income, so it is sustainable over the longer term. And although the starting yield is on the lower end at 1.5%, their 5-year CAGR sits at 11.6% overall, so that annual dividend is growing at a fast rate year over year. And going forward, even for a company that hasn't seen the fastest growth, analysts are still forecasting around 12% annual expansion. Add in the 1.5% dividend, you're still looking from their expectations between 13 and 14% annual growth per year for the next 5 years going forward. So even for a company that isn't expanding rapidly, analysts are still somewhat bullish and believe it will perform very well going forward. So those were 4 different companies. We took a look at Adobe, Lennar, Microsoft, and of course Oracle to take a look at for your portfolio over the upcoming week. These are definitely brands to add to a watch list. They all have a major event. We have a few earnings reports. We have an investor presentation. And over this week, which we're not expecting anything drastic to come out, still a few events to look forward to over the next few days. So I want to thank you for watching the video to the end. Please hit that like button and subscribe. Join the community down below, and I will see you in tomorrow's video.